You might have noticed that today is Innovation Day at Cadence, judging by the big sign over the front door. That's when they honor their patent awardees over the past year. I'd like to welcome our speakers. We have with us Rich Brenner, CEO of the Brenner Group, Rajeev Batra, partner at the Mayfield Fund, who is kind enough to stand in for Naveen Chadha, who is ill, Rich Garnick, CEO of the ConJoin Group, and Rich Lawson, managing partner of Huntsman Global Capital. Finally, of course, our moderator, Steve Bengston, director of Emerging Company Services, PwC. Thank you all for joining us this morning. Quickly, a few Churchill Club announcements. This week, on Thursday, November 5th, we present a breakfast program called State of the Startup, the New Entrepreneurial Order, led by Guy Kawasaki with a panel of founders of 5 startups from 5 different areas of the industry: Delight, Liaise, Objective Marketer, Vitamin D, and Unity Technologies. So it's not too often that we have 2 great breakfasts within the space of 1 week, and so we've decided to offer the people in this room something special. If you paid to get here today, you can register for Thursday's breakfast for free. So if you're interested, simply check in at the registration desk on your way out. Hope you can join us for that. Next, on November 10, the widely respected Jim Goodnight, founder, chairman, and CEO of SAS, is going to speak to you, our audience. SAS is the largest privately held software company in the world, and Dr. Goodnight is number 33 on the list of wealthiest Americans, according to Forbes this year. And I know that he is also a personal hero to many, and it's a very special opportunity to hear Dr. Goodnight speak. So please plan to come. And finally, it's our 7th annual version of the Gadgets program, featuring Walt Mossberg of the Wall Street Journal, Kara Swisher, his co-producer of All Things D, gadget geek extraordinaire Greg Harper, and their celebrity guest geek of the year is Facebook's COO Sheryl Sandberg. And that's December 3rd in the evening in Palo Alto. If you are not a member, we do encourage you to consider joining us. You can take advantage of either our corporate or our individual membership packages and be proud of your support of this organization and get yourself connected. Details on upcoming programs and membership are, of course, available on our website at churchillclub.org. I would like to acknowledge and thank our 2 sponsors for this morning's program. They are the ConJoin Group and Gutenberg Communications, with a special thanks to Hugh Burnham, who is here in the audience. It's been a great experience to work with these 2 firms, and I encourage you to get to know them. Our moderator, Steve Bengston, heads the Emerging Company Services Group at PricewaterhouseCoopers. Prior to his considerable impact at PwC, Steve was involved with 4 different startups, including as CEO of Why Not, an internet service company that I personally used and loved. He also ran sales and marketing for the group that co-founded Travelocity in the early days of the internet. Steve shares something in common with Warren Buffett and Bill Gates in that he is an avid bridge player. He may have some other things in common with them as well, but I'll let you ask him about that yourselves. Steve, we're honored to have you lead our panel this morning. Please welcome Steve Bengston.
Thanks, Karen. Well, today we're going to talk about venture capital and the private equity outlook, talk about what's new, what's different, what's coming, and we have our esteemed panelists of a bunch of rich guys and Rajeev. Well, in the past year, we've seen unprecedented change and uncertainty in both the venture capital and private equity world. And today we're going to address all those issues, solve all the problems, and answer your questions concisely. At least that's our stretch goal. The format for today is we're going to have each of the panelists talk a little bit about their background and their firms, as well as any topics that they think are particularly pertinent to this area. And then I'm going to start firing away questions till I see questions from the audience. So if you have a question, raise your hands early and often, and we'll try to get them all addressed today. And with that, we'll just go down the panel and start with Rich number 1, Rich Lawson from Huntsman Global Capital. Rich, you got the floor.
Maybe just a quick second on who we are. We are very much an old economy firm, but a brand new first-time debut private equity fund in this environment. We raised and closed a little over $1.1 billion about 3 months ago, which was, for us, quite an accomplishment. Pretty excited about that. We count among our investors some of the largest domestic and international pension funds in CalPERS and CalSTRS here in California, as well as AlpInvest in Europe, GM Pension, and Government of Singapore, and others. We have grown very quickly. We're pretty excited. Most folks know us more here in the Bay Area because my other partner is Steve Young, the former Hall of Famer's 49ers quarterback. And we recently had the former CFO of Citigroup, Gary Crittenden, join us as well. But very much an old economy firm. We've already closed on 3 deals with traditional financing, third-party financing in this environment in the last 3 months. So I hope to bring a very interesting perspective that there is a lot of opportunity out there for venture capital and private equity.
Thanks, Rich. And next up is Rajeev Batra from Mayfield, one of the oldest and most celebrated venture firms in the Valley.
So Mayfield's been around for about 40 years. We actually celebrated our 40th anniversary this year. We are a U.S.-focused venture capital firm that also operates with funds on the ground in India and China. We raised our 13th U.S. fund last fall, which is about $400 million. That's the size of the funds that we raise every, call it 3 to 4 years. We started investing that earlier this year, and we closed our first India fund, which is about $100 million, focused on lower middle market private equity investments in India, primarily non-tech, although some of our investments there are tech-related. And then we closed our third China affiliate earlier this year, which is also about $400 million. In the U.S., we are primarily focused on early-stage investment opportunities, although about a quarter to a third of our investments go in sort of later-stage special situation, sort of venture/private equity style investments.
Thanks, Rajeev. And next up is Rich Garnick with the ConJoin Group.
Well, thank you, Steve. And unlike the storied organizations that you both are with, and all 3 of you are with, our organization's new, but I'm old. I've been in the business of technology and global businesses for 30 years. I founded the ConJoin Group about 18 months ago. It's a different model. It's the convergence of capital, high-end strategy, global services, to basically focus on partnering and transforming troubled business assets. We've already made one investment where we transformed an existing portfolio company of a private equity firm, took an underperforming business, and in essence turned it around financially. And we're looking and seeking to invest in the mid-market companies that are existing in private equity and venture capital firms' portfolios, new or existing.
Thanks. And last but not least, at least according to him, is Rich Brenner from the Brenner Group.
Good morning, Steve. And speaking for the other Riches on the panel, my father always told me that he named me Richard with a nickname of Rich so that I could never be poor. And here we are today talking about private equity. Our firm, the Brenner Group, is 20-plus years old, and we have basically 2 distinct business groups. One provides interim executive management to emerging growth technology and life science companies, and the other provides private company valuation services and financial advisory services. And in both fields, we're either the largest or one of the largest in the United States for the service that we provide. But the reason I'm sitting up here today is that I have been an active angel investor since before the term angel investing really started, and that's over 20-something years ago, when early-stage companies were primarily funded by venture capitalists. And in the early 1990s, my partners and I saw a need to come in under the radar screen of deals that might otherwise get funded, provide them with a little bit of capital to see if we could get them started. And wasn't in the classic venture model. It was really just a group of guys providing some money. And today, the angel community has gotten very organized. And you don't see as many individual angels as you saw 20 years ago. What you see now are groups banding together to help each other in due diligence in management and in sharing expertise. And so that's sort of one of my reasons for being here. And two claims to fame that I want to throw out at the table on the group this morning. One is there's a small company. How many of you are carrying a Visa card in your wallet right now? Okay. I was the 7th employee of what is now Visa back in 1972 when it was National Bank Americard. And the idea of being able to have a card that was used worldwide was not very acceptable. And we had to put systems in place to try and help that. And the other claim to fame is I am on the board and one of the founders of probably the fastest growing bank in the country, which is Bridge Bank, located here in San Jose. And that was one of my angel investments that I did a few years ago that has turned out pretty well. So not only technology, but also financial services.
Thanks, Rich. Just to get a feel for the audience, how many of you work in private companies? Most. How many are in public companies? How many are actively now or will soon be trying to raise money for your organization?
How many aren't working?
Okay, that gives you a feel for the audience. The first question, all of you work in or around either private equity or venture capital. Could you just chat about what's different in your world from a couple years ago, and what do you think will be different in a couple years from now? Anyone?
All right, I'll kick off. First of all, as an angel investor a number of years ago, what we were looking for, was when you buy real estate, there are three things you look for, and it was location, location, location. When I was an angel investor, the first thing I would always look for is management, hoping that the management could navigate their way around any potholes in the road and develop a good technology. And so we would invest in them knowing, and there's the key word, knowing, that 2 to 4 years later, the venture capital community, if we had developed this great team and a good technology, would fund the company to completion. One of the early questions we ask now when we look at a new investment is how much money will the company need to make it to a liquidity event, and where is that going to come from? And if we don't have an initial opportunity to talk to a source now, and it's a lot of money, we probably will not want to invest in that as an angel deal. So that's one of the changes I think we've seen. The early stage companies are being funded by angels, but we are looking at where's the next round going to actually come from.
And from our perspective, if I may add, what we've seen is obviously what many of you have seen is, in essence, a reset economy. And the legacy of private equity-backed companies, venture-backed companies, that where capital was easy, have a new situation on their hands where they have to extend the runway to achieve that liquidity event because there's no clear path to IPOs. Strategic acquisitions have, you're starting to hear some, obviously just in the news today, Black & Decker and Stanley converged and are large deals that are talked about in the media. But where the big challenges is in the mid-market companies that were funded from 2000 to 2007 when capital was easy, financial leverage was the approach. We believe that you now need to go back to basics and earn your value the old-fashioned way through operational excellence, through streamlining the operation, efficiency and execution, and growing the top line through innovative means. And our business model is focused on converging those aspects together where you still leverage financial engineering, but it's linked tightly with operational execution.
From our standpoint, a couple of years ago, things had gotten obviously very frothy. We're seeing a lot of Me Too deals, management teams that were interesting, but they shouldn't really have been doing startups or trying to sort of yet copy another idea. Now we're seeing much higher quality investment opportunities. It is taking longer for people to raise capital. Valuations are, in the early stage business, valuations tend not to matter as much just because if the idea works, it works. But we're seeing a lot more sort of grounded teams, people who are very brave, not faint of heart, repeat entrepreneurs who are sort of getting back out there. We're seeing a lot of people come out of large companies because it's not that exciting to a large extent to be inside a maybe a Google or a Cisco or a Yahoo or whatever it is. So we're seeing a lot of high quality flow, teams that are much more grounded, more patient, and thinking through what they want to do a lot more before they sort of sit down with us. And we're happy to engage with people when they're sort of, before they're even starting to think about doing something. So that's the phase we're in, and I think we're in the phase where some new great companies are going to get started and created in. So we're pretty excited about what we're seeing out there.
I would caveat how we see the world a little bit differently because we're a little bit more later stage. So one of the more recent deals that we just closed was the world's largest manufacturer of pillows that you might find at Costco. So decidedly different type of model. But I think what might be interesting and useful is our challenges in trying to raise a first-time fund in this environment well in excess of $1 billion. And I think the things that really many sophisticated institutional LPs were looking for was, one, a significant commitment by the GP. So we committed as a small group of partners a little over $100 million of our money, cash, not fee waiver, to have real skin in the game. And I think that's fundamentally much how the VC and private equity model is changing as you think about folks fundraising. I think the other fact is, as we saw and we talked a little bit about the frothy market that occurred prior, you really need to be able to step up with a very significant track record. We were able to bring a track record of well over 200 deals with top quartile returns. So I think as we look at the landscape, it's fundamentally shifted. So many folks are out there now trying to raise follow-on funds or debut funds and are having significant trouble. Those were two areas that we felt we were able to distinguish and differentiate ourselves. I think the third one was our pure focus on the middle market. So rather than early stage or mega buyout, late stage, larger type deals, we were firmly focused on medium-sized businesses, predominantly in the U.S., where we could effectively bring global relationships, hence the name global in our name. But by really focusing on businesses that had $25 to $50 million in EBITDA or cash flow, whether they be emerging growth technology businesses here in the Valley, where we're in a number of dialogues, or other more traditional industries. But that paradigm has shifted. So having those three areas that we focused on really allowed us to raise a $1 billion fund in 13 months.
Now, for many people, debt has become a four-letter word again, and that really caused a lot of the problems in the private equity world, which used leverage magically, let's say, over the past number of years. That market is still really in chaos. It affects the private equity world much more than the venture world, although there has been a lot of venture debt in the venture world, more so in the past 5 years than probably ever before. But particularly for Rich Garnick and Rich Lawson, who probably look at the debt markets more, use debt more in your deals. How has the debt market changed? What is the current state? Can you get any debt? If so, what can you get? And do you see that slowly improving, quickly improving, not changing at all? How would you characterize the debt markets these days and your vision of what's going to happen?
Well, if I maybe just start on what we're seeing in the mid-market is that still a very tight credit crunch still exists in the mid-market. If you're not performing and driving cash flow, the banks and the lenders are really challenging many companies. We're also seeing a lot where we're seeing deal flow is where a lot of companies are missing covenants, and that's where it starts exposing opportunities where people are willing to acknowledge that they have challenges with their portfolio companies. Up until then, it's amazing to me how both the managers of some of these companies, the operating people, and the owners of these companies tend to actually go and delude themselves for a long period of time that there's not an issue. They don't want to face the brutal reality or the facts in a way that they need to. And it's only when they start breaking covenants that they have to acknowledge what's going on. So they need that outside influence to acknowledge where they're at with their situations. And that's where we come in. One of the things we're working on is building a shared service finance team that is absolutely world-class at helping not only with the operating finance aspects, but also restructuring the debt that has been layered on these businesses because it has been applied under such frothy conditions. The famous phrase of 2 years ago was covenant-light deals. Those covenant-like deals have all blown up. Last year alone, in 2008, there was 120 major companies that went bankrupt in North America. 75 of which were private equity backed. That says that the financial engineering alone has some fundamental flaws. And it's when you use great financial engineering, and it's an important aspect, but linked with operational excellence, that you could actually create shareholder value is what we're driving for. It's not rocket science. It's motherhood and apple pie. It's the basics. And the basics are, what you need to win in many games. You got Steve Young on your team. It's, Lombardi said, it's not that you have fancy plays. It's student body right. And when it was a matter of execution, it didn't matter what the playbook said. Now, he ran the West Coast offense, I know, and, he wouldn't have one or two plays.
Fair enough. And I think, as Steve will always say, part of our model is every deal we do, we employ traditional third-party financing, and we've been able to do that three distinct times in literally 3 months. I think for us, perhaps we're a victim or somewhat of a byproduct of the environment. By having no portfolio, we're not engaged in hand-to-hand combat with our banks and our prior portfolio on facility extensions or covenant forbearance agreements. So for us, we've had a more traditional and very successful relationship with these third-party banks. And I would tell you, as we sort of think about what we do spanning the globe from a pillow manufacturer in Boca Raton or oil field maintenance business in Texas or a especially transport business that erects windmills in Louisiana. In all these cases, we were able to actually get traditional, middle market, senior lending, plus mezzanine financing in every one of those deals. And I guess, quickly, in terms of what we're seeing, probably 2.5 times senior, turn and a half of mezz. So anywhere from 3.5 to 4 times, and that's very different from a market 2 years ago where people were relying on 4, 5, 6 times leverage. We just don't do that in the middle market and more medium-sized businesses.
Let me just comment from an availability standpoint. To the entrepreneurs in Silicon Valley, debt is available. That's the banking industry is alive and well. The banks are trying to find good companies to loan money to. Long gone are the days of if you got a loan from a if you got an investment from a VC to match it with debt. But the banks are actively looking to loan money. And the venture lenders, the long-standing groups, are back in business. They have raised new funds, and they're there to find a way to help you extend your runway. So, the woe is me that we heard about the debt crisis earlier in 2009 is the clouds are lifting, and there was probably a little bit of an overreaction. Interestingly enough, the tech sector, the lenders in the tech sector have not had as bad a time as other parts of the United States. And so this, the black cloud over the valley is not in the debt sector as bad as it is in the rest of the country. It is available.
The only comment I would make on sort of raising debt by venture-backed startups and early-stage companies is that venture lenders should look at the company and the teams that they're backing.
Absolutely.
Because, there was this model of reliance on, hey, the venture investors will ultimately underwrite the debt investments that debt investors would make. And that's just that model's not necessarily going to play out. And so you have to look at the quality of the syndicates. And when we reserve for our investments and our companies, we are sort of thinking about the syndicates we're in. And if we think that there is any weakness in the syndicate, we have to sort of think about the reserves very carefully. And so this notion that the venture investors will sort of carry the bag for the debt investors is a flawed view. So as entrepreneurs, you should be mindful of that. And I agree that debt's available, but it is expensive, so one has to sort of figure out. And in the right situation, it makes a lot of sense. And so we, in the right situations, we do encourage our companies to think about, sort of extending their runway and thinking about capital structure in a more effective manner.
The one thing I'd add to that, though, is, the warrant-backed lenders, many of them have realized that cash today is more important than warrants because the opportunity for home runs on warrants that they used to take in every deal they did has diminished, dramatically. We're going to talk, hopefully, this morning, Steve, about the IPO market and the exit market, but the values have gone down. And so the value of the warrants has diminished. Therefore, the yield to the lenders is probably higher now on a cash-on-cash basis than it was 3 years ago or 2 years ago.
And make no mistake as well, overall pricing, while there is financing out there, it's very different from 5 years ago. So LIBOR plus 325 5 years ago is now LIBOR plus 700. So I think to the point of really understanding businesses and not relying on financial arbitrage, you really need to have an operational hat to understand where these businesses are going. Zero growth LBOs, zero growth type deals, relying on arbitrage on the back end is not going to be something that can be successful in the long term in this environment.
Okay, let's talk about the world. All of you play on a global stage. It's kind of an interesting dichotomy now. In the PwC Money Tree just released Q3 this year, Silicon Valley had a record high market share for the U.S. 46% of the dollars invested in the U.S. were in Silicon Valley, which is why we're probably having this meeting right here. Even though, think of all the cities in the world that are trying to be the Silicon fill in the X, yet Silicon Valley's market share is literally higher than it was 13 years ago when we started the survey. But every day we read about India and China and a whole host of other countries also trying to be the Silicon fill in the blank. All of you play globally. Let's talk about what's going on in China, India, and other markets that you're excited about, and what kind of threat do they pose to Silicon Valley and the U.S. more broadly, short term and longer term?
Well, my greatest focus is where we have operations in India, but we've been in China and other parts of the world. In India, I think you're seeing overall economic growth has come back faster. But I think the issue of where people are putting money into ventures, it's still an emerging market for New Deal initiatives. I think they're looking for the mega opportunities are in infrastructure within the domestic Indian marketplace. It's in India still has a 30 to 50 year runway of rebuilding the country, which I think has a lot of latitude to and headroom to grow. Whether it be water, power, and infrastructure. In China, I think their focus is obviously manufacturing and export. So you're seeing opportunities, but the concentration of deals being done right here in this bay. I'm actually a resident of the other bay in Boston, on the east side.
We call it East Bay.
East Bay, that's right, where the Red Sox play.
The very east.
We have a good baseball team, hopefully. But you have all the investment. But I think it's you got a tremendous dynamism here in the Bay Area around technology and innovation that's really powerful, and it's around creative destruction and rebuilding enterprises on a perpetual basis, and that is what we have to stimulate. And I'm worried a little bit about the overreach of government getting involved with business activity and will stymie the innovation that will come out of this sector. And for all of you entrepreneurs in this marketplace, each time we go into a recession, people pull back. I launched the business at the time of the recession primarily because that's when great businesses get founded. And we wanted to get out there, and we saw opportunity within those dark clouds. And those opportunities are plentiful. You just have to have intestinal fortitude, because it is not easy. And you have to have a clear vision and be grounded at a management level. One of the things we chose to do is our management team happened to be many people that have worked with and around our organization in the past, so there's a deep understanding and heritage of working together, so that when you go through good times, everybody, it's real easy. When you're going through challenges, you have to be able to work as a team to be effective through those challenges. So these are some of the things you got to be thinking about. But from a market standpoint, I see India and China as being dynamic challenges, but opportunity for us if we embrace it. We shouldn't look at it like it's a threat. We should see it as an opportunity, and how do we take advantage of that as business people and entrepreneurs in this marketplace?
Our view has been, when we invest in India and China, so we have funds that are focused on those geographies, so we don't invest out of our U.S. fund into those geographies. And we have local teams that are on the ground, and we have sort of matched the investment philosophy and strategy with what we see as the opportunity. So, for example, in India, I agree with Rich to my right, is much more about sort of basic infrastructure, basic services, and it's a big macro play. India is largely sort of like the U.S. was maybe in the 50s or 60s, and we typically invest in companies where we get in. They're still sort of subscale, maybe 5, 10, 15, 20, 30 million in revenues, growing 100% year over year, where we're buying in at 2, 3, 4 times, 5 times EBITDA at the most. And so you're really looking, you're playing into the growth trend, and leverage is not, it's not available. The debt markets are not like the markets are here. And in China, it's a similar sort of approach, but it's more focused on the internet and mobile space. But the two recurring themes in both those areas are we're focused on domestic market opportunities as opposed to companies that are going to rely on global markets. Although if the companies have an opportunity for global markets, that's nice and interesting. We think in order for venture capital and private equity to thrive in a meaningful way, you have to be able to serve sort of domestic markets and build the business from a long-term standpoint on the local economy. To your point, Steve, this whole question of why 46% here in Silicon Valley. I moved to the Valley about 7 years ago, but I've been coming here for the last 15 years, and I never understood this whole sort of craziness about Silicon Valley. It's like one idea after another, the next idea crazier than the one prior to that, and it's only after being here for a few years you get it. People in the Silicon Valley are purveyors of dreams, and that's what I think allows people to sort of think the impossible, fall down, get back up again as if nothing had happened, and start all over again. And it is a very, very unique characteristic that is very, very special to this place. And even outside of the Valley in the U.S., that way of thinking does not sort of prevail. So people here are purveyors of dreams. That's what they keep doing over and over, and sort of marshaling their agenda. And I think that's what makes this place attract the capital that it attracts. So.
Yeah, I'm almost a contrarian a little bit to the idea of a threat from India and China. If you study history, if anybody's a history buff, in every industrialized society, as any industry matures, lower cost markets are found to continue the development of that technology or that industry. Whether it was the printing presses from the 1800s or the television market or the automobile market, and now we're in the PC markets, it always goes to a low-cost market. And right now, we had a big fear of outsourcing everything to India back in the late 90s. And then it was China was going, well, in the 80s it was Japan. And then you had India, and now people are, China. Well, China and the U.S., by the way, have this symbiotic relationship. We depend on each other. If China ever decided to stop exporting and stop buying our debt, our economy would see an incredible inflation rate. But so I think China's economic balance with the U.S. has to stay intact. But I think there are other markets where we're going to see, if you look at India today versus 10 years ago as an example, wage rates have come up and have rise dramatically. And so the cost savings that companies saw a number of years ago in India are not there. Eastern Europe is developing, I think, as another potential brain trust, if you will. There's low-cost labor, there's very intelligent engineers, and I think we're going to see a movement of a lot of venture money into Eastern Europe. But to your point, Rajeev, it was very interesting. I did some work in Europe a couple of years ago, and I've done this in Asia. And when you see the reason they can't replicate Silicon Valley, I think there's two factors. One is failure is a stigma. It stays with you for life. And in around here, if you get some skid marks on your back from a failure, that's a badge of honor, as long as you learn from your mistake. The other issue is how high the tree grows. When you see a business plan for an entrepreneur in a different market other than Silicon Valley, and they see a success of a business at $5 million, 5 years, 7 years out, they're not able to see how to grow a business to be a Cadence or a Cisco or an Intel. They just don't have that. the mentality of the international community doesn't have that same entrepreneurial spirit. So I think that we will continue to see outsourcing. We will continue to see a globalized market, shrinking world. But I think that we're going to go from Japan to India to China, and I'm looking now at Eastern Europe as an opportunity.
On that point, though, if I could just touch on, I agree with a lot of what you said, except the last piece where you talked about the fact that people seeing the success and scaling. In fact, in India, companies like Wipro, Infosys, TCS have grown from nothing in 2000, very small companies, to multi-billion-dollar corporations, and they have hundreds of thousands of employees in each of those. And many of the employees have dreams now that say, not only do they have an innovative idea, but they want to build global enterprises with scale of that nature. So I think it's a generational shift. I think that's an opportunity. That's a challenge.
You're calling me old. I got it. Okay.
Well, we're both in the same era. So, at Wipro, for example, we had 70,000 employees when I was there, and the average age of the population was 26. That's the average. I was the old man in the organization. And, you have all these, and in fact, India will have 45%, I believe it is, the demographics of the world population under 15. And so therefore, we got some demographic shifts going on that I think we got to be cognizant of. But I think Silicon Valley is unique. And I'm not saying there's challenges, but with those challenges, recognize them, and you can turn them into opportunities.
Okay, speaking of which, just a random fact, roughly 2020, India will have more people than China. So that'll kind of change the tenor of the conversation. But our panel today was billed as Venture Capital and Private Equity Outlook, implying, what is the outlook for later this year, and more importantly, 2010 and 11. So in your worlds, what do you think will be different, if anything? Is 2010 going to look a lot like 2009, et cetera, or is it going to be better, worse, and specifically what's going to be better or worse? Rich Lawson.
I think the dislocation between sellers' expectations and buyers' ability to finance is certainly beginning to moderate. So we're seeing quite a bit more activity. I think that, in conjunction with the fact folks are looking at and very concerned about tax treatment in this country related to cap gains and ordinary income, is also driving some activity that we've begun to see. So I think generally there's more optimism. There's obviously the credit markets are coming back at a level that could support some transactions, whether here or abroad. Skype is a great example with Silver Lake, and others is a larger deal that actually relied on third-party financing, traditional financing. So I do think that there is a sense of optimism. Again, my view will be very interesting to see, because many others believe that the future of private equity in particular is very challenged. And I think you need to really segment out what and how you define private equity. And I think today there is an opportunity for a number of new emerging, not to be talking about our opportunity, but first-time funds to come out with no portfolios and create new platforms, because many of the current funds that are out there have experienced great difficulty in having large portfolios that were over-leveraged, that will require an enormous amount of work in the coming years. So I think while there is a sense of optimism, I think there'll be great challenges for quite a few people in the private equity community to continue to deliver decent returns in the next 5 to 10 years.
Yeah, I think the venture industry needs to be a healthy industry. Means it needs to generate good returns for its limited partners, and so the pace of investment activity feels like the pace at which we are at right now, plus or minus, is the right pace to actually generate the returns that the asset class has traditionally generated and investors have looked to. The pace of investing that you saw sort of in sort of the 07, 08 time frame, which was sort of clipping at about $6 to $8 billion a quarter, was not healthy. It's just not going to generate the type of returns.
So Rajeev, you'd predict we'd be in the $4 to $5 billion a quarter range next year. That feels more like equilibrium.
I think 4 to 5 is probably, unless you sort of have a whole new sort of sector, whether it's energy tech or clean tech or whatever, start to emerge. If you're sort of investing in more traditional enterprise IT, consumer, internet type of sectors, I think even $4 to $5 billion is probably too much, because the industry as a whole has been sending back call it about $10 billion of returns annually. And if you're investing $4 to $5 billion, you're sort of outpacing the capital that you're even sending back.
So that would imply a slight decrease next year because we're at $4 to $5 billion now. I mean, Q1 is the only quarter in the last 10 years below that.
Yeah, I'm not saying that we'll go down. You asked the question, what's healthy? I think healthier is probably a little bit lower, but I think we're all optimistic, so we'll probably be around where we are. But I think one area that we will see pullbacks have to do with what Rich to my left has said, is that people will be running out of capital, and there will be a bunch of funds that just won't be able to raise follow-on capital or new funds, and so you'll probably see some of that retracting, and there will be some consolidation in the industry, and you probably will not see as much money going into sort of pure venture as it may in sort of growth capital or some other areas that a lot of venture firms are extending their footprints into.
To expand on that just for a second, I guess, our view is the outlook, it's a function of where the funds are in their life cycle. The legacy funds that have been invested since 01 through 06, 07, we see opportunity for our business model because they will be challenged for exits and for dealing with what do they do to extend the runway, either or get follow-on funds or whatever they deal with their existing portfolio. And for new funds like yourself, the landscape's wide open because you don't have that legacy. You have really a great buying opportunity, and that's where we're at too. Because we think valuations were really frothy 2 years ago, and the opportunities just weren't as rich as we think they are today. Because you always, it's pretty simple. You want to buy low and sell sell high. It's not rocket science. The trick is executing between those troughs and peaks. So we're focused on that.
Well, I'm going to look from 2010 and beyond, not just for 2010. I think 2010 is going to be equal to approximately the $4 billion a quarter range. I agree that that's a comfortable level that the community can handle. I also agree with Rich number 3 that we got to be careful to not outpace the amount of money that's available. The traditional venture model that we have seen is changing, and where we used to have, as recently as 10 years ago, we had a bifurcation between venture. The venture capitalists took the early stage to middle market companies, and then it went to private equity as a mezz round, and then you'd have a liquidity event. I think what you have now is that I'll call them the organized angel community is picking up at the very bottom of that, which will feed into a venture community, which will feed to private equity, because the exits come later, and it takes more time and more capital. I believe that 2010 will start seeing a fallout in the venture community. The numbers of funds are going to drop dramatically as people have invested their capital and can't raise another fund.
What's dramatic? You think half the funds will go away?
I don't know, 40, 50%, Steve. I mean, it's in that magnitude. And by the end of 2011, I think we'll see most of that played out. 2011 economically is predicted to be is going to be worse than 2010, but not recessionary. And 2012 is when the economists predict that this thing starts really coming out. So look for a reasonably good 10, flat to down in 11, and then coming out in 2012.
Okay, on that up note, we're going to go to questions from the audience.
No, come on, Steve. I used to be a lot more negative than that.
Come on, Dr. Dez, calm down. Question in the audience over here.
Hi. I was wondering if you guys could comment a little bit about maybe some specific industries that you might be interested in or that has some potential for growth in the next year or so.
Okay, industries. Some quick firing answers.
We're focused on business services, technology-enabled business services in healthcare, financial services, and telecommunications primarily, where we could affect the business with our model.
Medical device, life science, clean tech.
Next generation enterprise data centers, software as a service, cloud computing, I think are big long-term macro trends as enterprises retool themselves, and these technologies finally enable sort of what we call the true democratization of IT and proliferation of IT into the true middle market, lower ends of the market, and global markets. We do believe that energy tech is a very interesting opportunity, and that's distinct and different from what a lot of people in the Valley call clean tech. It's not just enough to be clean. You actually have to have an economic basis for investing in energy-related technologies. And we think that the third area that's on the periphery and is also going to be pretty exciting is education, delivering education through sort of innovative means, using the internet and other things, and healthcare, technology, and IT.
We're really focused on industrial services right now, anything that touches the industrial world from a services standpoint. Business services is also an interesting dialogue. I will tell you that opportunistically, many things have come to us as a result of this larger impact that we've been talking about in terms of venture capital and private equity, whereas 2, 3, 5 years ago, you wouldn't think that in a million years a venture firm, whether it be early or mid-stage, would approach a later stage middle market private equity firm. But you can't have always the number one cloud computing deal or network storage deal. So over the past 5 to 7 years, there's a portfolio, a massive portfolio of number 2, number 3, number 4 players, where we're now having dialogues opportunistically that we didn't even search out proactively in a variety of sectors and technology, specifically with venture capital firms as opposed to third parties.
Okay, I got a second question right here.
So my question is, I guess I see private equity and venture capital as distinct asset classes. So my question is directed to Ravi and to Rich. Rich just made the prediction that there'd be a...
Yeah, Ravi and Rich doesn't really narrow it down.
Rich Brenner just made the prediction that there'd be a substantial consolidation in the space in the area of venture funds. And I do remember, Steve, maybe 6 or 7 years ago, you also stood up and made a similar prediction.
That's why I have Rich say it now.
Right. But in fact, what happened back during that time period is that as the industry consolidated, it also fragmented. And what happened is that there was a lot of money that poured into some of these boutique venture firms that sprung up across the landscape. So I guess my question to Ravi and to Rich Brenner is, why is this period different than it was back in 2001, 2002, 2003?
I think the first thing is to look at the return on investment that the limited partners have seen in the last 9 years. Back in 2001 through 2003, the limiteds were still riding on the return on investments from the 90s. And they were the venture, and as a sector, venture community was returning 20+% at that time. Today, if you look at a 20-year average, they're down to, what is it, 14, 15% now, Steve?
Yep.
But if you look at a 10-year average, it's negative. And so that's why you're going to see the shakeout, I think.
Yeah, I mean, I think, look, capital always chases returns. And so, there are no returns, so capital may retreat. But I think it's also fundamental liquidity, right? It's driven by liquidity. You see Stanford and Harvard selling off their alternative investment portfolios. I mean, when blue chip limited partners are sort of retreating from the asset class, what does that mean overall? So I think it's a combination of factors, and maybe it's a perfect storm sort of ensuing at this point, where a lot of these firms are end of life. Their funds, they haven't been able to raise more capital. It's the asset class isn't generating the returns. It's retreat of LPs. It's a variety of different, I think, factors. So we'll see how it plays out. But one thing to keep in mind as a perspective is the venture industry raising, whether it's 10, 15, $20 billion annually, is a drop in the bucket when it comes to the overall private equity investment landscape. So from a real macro standpoint, it's really noise. But we will have, I think, a bit of a shakeout.
Yeah, I got time for one last question. Better make it good. Nothing. Well, I'll go. We alluded to exits. IPOs have been up a little bit this year, but still terrible by historic standards. There's been a lot of M&A deals, but the median M&A exit is something like 25 million with something like 16 in, so you don't make it up in volume. So exits have been terrible. I mean, that is why the returns to the venture industry have been terrible for a long time. The iBankers are just talking about all the meetings that they're having to file S1s and talk about the S1 filings in September, and they're holding all kinds of meetings. Endless enthusiasm from that sector. What do you guys see? Do you think 2010 will actually be better than 09 in IPOs or M&A, or are we looking at the same pretty weak year?
Marginal.
Marginal.
I think the open table IPO, which was going to lead the charge again on IPOs, from offering to now, it's up, but only up 15-20%. There are about 6 IPOs that were filed for registration last week. Now, whether they all go out this year is still up in the air. But there is a lot of pent-up demand if the market is going to be receiving it. You know, we lost a lot of ground on the Dow last week. The investors going back into their hibernation mode, it's unclear. So I don't know. I think that there is a pent-up demand, Steve, whether it's sometime in 2010 or beyond. I can't predict when it's going to break.
But you'd say 10 looks a lot like 9.
Yeah, I think there's a lot of uncertainty. Investors hate uncertainty, and we have both economic uncertainty and we got fiscal uncertainty with tax regulation and tax law thrown wide open, and what's going to happen to the investment class if long-term capital gains goes. Some of the other policies, I don't want to get into a policies viewpoint here, but it's creating uncertainty that is delaying investments and creating opportunity in the sense that people are going to have to extend their runway because they won't have exit opportunities as frothy as they have in the past.
Well, so far we got 2 votes for 10. Looks a lot like 9. Does anyone have a different perspective?
Steve, I think I'll answer the question slightly differently. I mean, I think the question is one of exits and sort of a vibrant exit environment and sort of how do people achieve liquidity. I think people have to sort of think about IPOs in a different way. Most tech companies that go out are sort of, they don't move the needle for institutional investors. If somebody gets a $5, $6, $7 million allocation, these institutional investors are large guys. It just doesn't move the needle like it did maybe 10, 15 years ago. And so the way the industry has to think about exit and liquidity is to think about broader set of options. Yes, you need a vibrant, healthy public market in order to encourage or to sort of make sure that the companies have good currency, larger companies have good currency, and the threat of IPO is a viable one for M&A to step up, which is what we've been seeing. There's a lot of cash-rich tech companies that have to, in order to grow, acquire, and that model is now an absolutely proven model. It's not about competing with Microsoft or Cisco or Oracle. It's really figuring out where the gaps are and filling those for tech companies. And I think beyond that, we have to be more creative about secondary markets, secondary funds, private equity companies, buying portfolio companies of venture-backed companies. So I think you have to think about, and also going public on international markets and things like that. So you have to really think about liquidity and exits in a much more broader sense, because I don't think you have an IPO market that's going to look like 96, 97, 98, 99. And truly, the companies that truly deserve to be public, there's not many of them, the ones that can just sort of continue to be independent, strong companies long term.
It's interesting for us, it's somewhat counterintuitive, but I think the point we've discussed on the panel, the period of somewhat negative returns in the venture industry in many ways has driven the kind of increased dialogue we've been having, because as you think about going out to raise another fund, if you will go out and do that successfully, you need successful realizations. And there is a new paradigm, at least for us, that we're seeing as a fund that is now crossing over into private equity and venture capital. As venture companies have become more traditional middle market businesses, the opportunity exists for many of these companies in the portfolio of some of the larger, more established VCs out there to take some chips off the table. So I'll tell you, we're in 6 or 7 dialogues today where there's an opportunity to come in and allow that VC to, in the absence of a frothy IPO and new issues marketplace, take some significant chips off the table, perhaps continue to roll over and own 20, 30, 40% of the business, but be able to mark to market what the value of that investment was. And I think that, so for us, as we see where the IPO market is, it's probably challenged, but it creates even more activity on the M&A side, at least it has been for us. And I think that will continue over the next 2 to 3 years.
I absolutely agree with that, and I think that, you know, we started this dialogue this morning. Rich number 2 here talked about getting back to motherhood and apple pie. If you're building a business, build a business which can sustain itself at some level. And maybe the tree doesn't grow to the sky, but it becomes a nice elm tree. So grow a business that can sustain itself, be cash flow positive, and then if the opportunity arises for attracting capital for growth without turning you into a cash pit, a cash drain, that makes a lot of sense.
Okay, with that, I want to bring up Karen Tucker, CEO of the Churchill Club, for some final comments. Thank you.
Where you are. So Rich, Rajeev, and Steve, thanks very much for sharing your insights and opinions with us this morning. As a very small token of our appreciation, we'd like to present you with a limited edition, much sought-after Churchill Club T-shirt. Thanks again to our sponsors, Gutenberg Communications and the ConJoin Group, to Cadence for hosting us, and to all of you for coming. Thank you very much.
Nice to meet you, yeah. When you're out in the area, we need to meet you.